Hey everyone, welcome back to the channel. Been getting a lot of questions and comments about what are your thoughts on these new launches that are going to be done by Evolve ETFs soon. So let's go through the press releases, everyone. Evolve plans to launch the Evolve US Equity Ultra Yield ETF. So the stock symbol is going to be BIGY. And by the way, they're also launching a Canadian version, Canadian equity version. Ultra Yield ETF as well. The stock symbol is going to be MAPL, but we'll check out and focus on BIGY, but the language is pretty much the same, or the strategy anyway seems to be exactly the same on both these ETFs, except MAPL will have Canadian stocks and BIGY will have US stocks. So let's go through the objective here, everyone. Let's see what's going on. We are pleased to announce the filing of the preliminary prospectus, and by the way, we will check out the preliminary prospectus soon for some more details. And some of it might shock you like it did for me. For our first Ultra Yield ETF. So looks like they're making a series. Maybe they'll do more than two eventually. We'll see. So BIGY is designed to address Canadian investor demand for income by providing exposure to leading US companies. Okay, so leading, big cap companies with enhanced yield from a covered call strategy, more frequent cash flow with distributions paid twice per month, but a little bit more on that later because they might actually increase it to weekly from the language of the prospectus. We'll see that in a second. So BIGY seeks to provide attractive income, long-term capital appreciation by investing in equal weighted portfolio. Okay, so it's going to be equal weighted. Evolve does a lot of equal weighted stuff like bank, Utes, and oily. They typically stick to the equal weighted of leading US equity securities. So, probably leading big cap stocks, big names that we know that have the potential to generate significant option premiums. So to enhance yield as well as to mitigate risk and reduce volatility, BIGY will employ covered call writing program at the discretion of the manager. Very typical covered call ETF language here, right? Because you are technically mitigating risk and reducing volatility when you're doing covered calls on something, right? The level of covered call option writing may vary based on market volatility and other factors, which leads me to believe this is an active strategy, active covered call strategy, which Evolve does for everything, right? This is not a passive strategy, not a rinse and repeat, which is a good sign in my opinion. Here's something that's interesting. BIGY will use modest leverage in order to seek blah, blah, blah. The aggregate leverage will not exceed 33% or 1.33x. So this is the second. BMAX was the first from Brompton, the second covered call ETF in Canada that's going to be using up to 33% leverage instead of 25%. A little bit more leverage, which is very, very interesting. And you're actually going to have three stock symbols. One is going to be hedged to the Canadian dollar. One is not going to be hedged to the Canadian dollar. And you'll even have a USD version as well, which is very interesting. So same exact language for MAPL. This is just the same thing, same strategy, except on the, it's going to focus on Canadian stocks. But there's a lot of details in the preliminary prospectus, which I found very, very interesting. So let's go through it. So the investment objectives here. Sorry, this is a bit repetitive, but I'll go through it here. Leading U.S. securities. I'm on the BIGY one, by the way. Leading U.S. equity securities that have the potential to generate significant option premiums to enhance yield, blah, blah, blah. Call writing program may vary. We read that. We'll use some modest leverage, which we saw 33%. Okay, so let's go through it here. Investment strategies. Primarily in equities in the United States. Okay, so this is where it gets a little bit more interesting, a little bit more detail. In order to achieve its objective, the manager constructs the portfolio by screening the largest U.S. equities by market cap. Okay, so the Mag 7, etc. From this universe, securities are ranked based on their volatility, with preference given to those offering attractive option premiums. Using a combination of size, volatility, the fund manager will select the stock. So it looks like they're going to be screening for high volatility stocks. So I won't be surprised. I'm not going to be surprised if there's a lot of the same stocks, for example, that HHIS has. This is obviously, they're trying to compete with HHIS in my opinion here. So I wouldn't be surprised. I would be very surprised and disappointed if Strategy's not there and Coinbase is not there and the Mag 7 is not there. The chip makers should be there, AMD, Broadcom, all of those should be there. The Evolve fund will use leverage, a maximum of 33%, like we saw. But here's where it gets very interesting. The manager believes that option writing may have the potential to enhance yield, blah, blah, blah. All other things being equal, higher volatility in the price of the security results in higher premiums. We know that. The manager believes that equity securities of the Evolve fund are suited for a call writing strategy. Yes, covered call options will be written by the manager at its discretion on up to 100% of the equity securities of the portfolio at any given time. So to me, this is, I when I first read this, I thought, are they doing 100% covered call coverage? But I don't think it's the case. I think up to 100% of the equity securities of the portfolio, which means if there's 10 or 15 or 20 stocks, they'll do calls on every single one of the stocks. That's what I think. Hopefully it's not, we're covering 100% of the portfolio with covered calls. We know that over the long term, it's not really a good idea, right? That's just my personal opinion. Here it gets very interesting. It mentions 0 DTE, everyone. So the Evolve fund may invest in options contract with very short times to expiration, including 0 DTE, or if deemed appropriate under specific market conditions, options with the shortest remaining maturity available. So it looks like they will have the ability to write or do 0 DTE call options, which we know are available on the indexes only right now, on the S&P 500, on the NASDAQ, and on the Russell. So it looks like they're giving themselves that option. So it's they're opening the door for a much more complicated, much more potentially lucrative option strategy, including 0 DT, which is very, very, very interesting. I cannot wait to find out on how much of the portfolio max can they write cover calls. I hope they don't go over 50%. I think that will probably be the case. And if we scroll down in terms of distributions, leverage, let me borrow cash. So for the leverage here, it says 50%, but I think that's only maybe on the mutual fund. I'm not exactly sure, but here it says max 33%. Anyway, guys, I'm sure I'm going to have Raj or someone from Evolve on the channel to discuss this in detail. We'll get the details when it comes to the leverage, the portfolio coverage. Don't worry about it, guys. I got you covered. But in terms of the what did I want to show you here? The distributions, yeah. So here it is. Distributions will be payable at least semi-monthly, with the possibility of more frequent distributions at the fund manager's discretion. That's pretty cool. So maybe Evolve is going to be the first manager to launch weekly distributions in Canada. So that is, I'm sure, a lot of good news. Some good news for many of you watching, because many of you, I believe, really like the weekly distribution. Who doesn't, right? Weekly paycheck. And by scrolling down, I also see that the management fee is actually very reasonable on the ETFs. It's 40 basis points. That's a very low management fee, and I believe even lower than their index-based covered call ETFs, which I believe is 45. Let me just double check. So this is a really nice low management fee here, and Evolve is known to have a little bit lower, more competitive management fees. So yes, I was right. If we look at ESPX, which is just their basic S&P 500 covered call ETF, the management fee is 45 basis points. I have no idea how they're able to, for something that is looking, of course, doesn't include a leverage cost. This is management fee, not the MER. The MER is going to be much higher, especially when you're using more leverage. But because interest rates are so low in Canada, I think it's a great idea. Honestly, I always was curious to see and know what 33% leverage instead of 25. It's just slightly higher. Personally, I'm very comfortable with 25 or 33. I think 50 might be a little bit too much, but I'm very curious about this. So I just can't believe how the management fee is going to be 40 basis points. Of course, this is the preliminary prospectus. Maybe it'll change, but that's a really good management fee for something that's going to be, actively managed with monthly distributions, maybe even weekly, with some 0 DTEs, possibly. That's pretty good. So very exciting here, guys. I mean, this I think has definitely the potential to be the highest yielding, maybe even 30, maybe even 40, 50% yield. Because if they're going to do 33% leverage, if they're going to select stocks with very high volatility, if YMAX could do 40, 50, 60% yield without any leverage, well, I don't see how Evolve can't do it or more with 33% leverage. So I think this is going to be the highest yielding ETFs on the Canadian market. That's my personal opinion. I think it could be way north of 25, 30. I think it could easily be between 40 and 50%. And it's just, it's very interesting as well. I'm very curious about the Canadian equities as well, because those are not that volatile, right? They're not that volatile, but it seems like they're going to have the ability to do zero DTE options in the United States on the S&P and the NASDAQ. So it kind of maybe reminds me of what Hamilton is doing for C-Day and S-Day, right? They have Canadian dividend stocks, no covered calls on those, but they're doing the covered calls, the zero DTE calls on the indexes. So maybe they're doing a similar strategy. So this is definitely to compete with my opinion here, definitely to compete with HHIS, right? They probably saw HHIS' success and let's try to evolve. Let's try to evolve it more and do a little twist on the strategy. So I'm very, very curious about the stock selection. I personally, I hope there's at least 15 to 20, 25 stocks. I think like 10 stocks, like their Utes and Bank and Oily is a little bit too low, but maybe they'll have a universe of 20 and the portfolio will have 10 equal weight. I'm not sure. I'm very curious about the 33% leverage. I think that's good. Semi-monthly distributions with the possibility of weekly, I think is good. To me, it makes no difference. I reinvest, or I do my reinvesting once a month. So to me, it makes no difference. But I think weekly could be very interesting. I think the more frequent the distributions are, I think when you have it on drip, it could have a little bit more of a compounding effect over time. 33% leverage, that could really add up over time. So this could be considered even a growth investment if you have it on drip, right? You put something on drip, it's a growth investment, guys, okay? Very, very simple. I'm surprised of the low management fee. So yeah, I'm looking forward to discussing this with Evolve. Evolve already reached out to me and asked me to meet up in person to discuss this in Toronto. So I'm going to be talking to them in a few weeks, and hopefully we'll do an in-depth Q&A video, or I'll reach out to you, to the Inner Circle members, to let me know the main questions you have. But of course, the main questions I'm going to be asking them should cover everything, right? Cover call strategy, stock selection, and I'm sure that when they actually launch the ETFs, we'll have a lot more data. So hopefully this was enjoyable for you. Give me a thumbs up. I would really appreciate it. What are you most excited about these ETFs? Are you excited about them? Is it the low fee? Is it the more frequent distributions? Is it the higher leverage? Let me know in the comment section below. I'm sure Evolve will read them. And take care, everyone. See you next time.